Passive ETFs have been the long go-to for most investors. They're cheap, they're simple, they get broad market exposure with very minimal investment. But what if I told you that 2024 was an absolute turning point where active ETFs seen a much higher cash flow of around $330 billion, making up a total of 22% of all money going into new ETFs? That is huge. Today, we're going to break down passive versus active ETFs, what each one is, the risks and the rewards for both of them, and whether they should earn a spot in your active portfolios. Hey everyone, welcome back to the channel. If you're a smart investor or building a portfolio that works for you, you are definitely in the right place. In today's video, we're going to be covering what the passive and active ETFs are, what ETFs are actually booming right now in that active space, the pros and cons of each of these, some real active ETF examples that you can look into, and of course, the strategy that fits the kind of investor. So let's go ahead and jump into this. When it comes to a passive ETF, it simply tracks a benchmark. When we think about the S&P 500, thinking about the NASDAQ 100, even sector indexes, they are tracking a very specific index. No manager trying to beat the market, really a passive investing strategy. The goal is to match the market, but never actually beat the market. Now, of course, with these, they come with an incredibly low expense ratio, sometimes even under the 0.1%, diversification in one single asset, full transparency to where it's being invested in. But why are the active ETFs seeing an absolute boom right now? These ETFs have an active manager, meaning there is AI, there is an actual person that is making the decisions on what they're investing in, going through picking stocks, making allocations, making adjustments, even sometimes using derivatives to go ahead and boost what we see the returns on those ETFs. Now, according to the SSGA, 2024, there were around $331 billion in inflow, which again is about 22% of all active money going into ETF. Now, this is when we started to see the strategy change, which was last year. So with these new strategies, we are looking at structured outcome or buffer ETFs. Now, if you're unfamiliar with these can protect you from the downside in the market and also cap the upside. So it's almost playing a double kind of side there where the minimum that you can lose is kind of capped, but also the cap that or the earnings that you can get is capped as well. Now, the big and one of the most popular things that we have seen are the options-based income ETFs. These have been on absolute fire lately. These are the ones that write covered calls or option calls to boost the yield and giving you money on a weekly basis or a monthly basis and generating an incredible amount of income at the cost of the actual stock price of the ETF. Now, there is also thematic ones. There are factor rotating strategies, flexible income ETFs. There are so many things that are being introduced. And for the first time last month, we actually exceeded the amount of ETFs that we have in the marketplace versus the amount of stocks that are actually available in the US index. So what do some of these active ETFs look like? We're going to take a look at three of them, starting with the iShare Advantage Large Cap Income ETF. The ticker symbol on this one is BALI. This is an outcome style ETF. If you break it down, invest into large cap, uses a dividend rotation model, right? Monthly option calls on the S&P 500. So it's very similar to what I have with some of my XDTE and my QDTE, trying to enhance and generate income. So you get dividends and you also get an option premium in there. So they're using stocks that are the high performing dividend stocks and also doing option calls against them, which is a pretty interesting strategy. Now, the second one we look at is the iShares US Equity Factor Rotation Active ETF. Ticker symbol on this one is the DYNF. Now, this very interesting because it grows dynamically rotating across different factors and different sectors like value, momentum, quantity, minimum volatility, and size, using market volatility to generate income when it is favorable at different times. Now remember, these are actively managed, meaning you have an individual that is going in there and actively changing what the investments are. It's not just set in the S&P 500 or that NASDAQ 100. It is changing up from time to time. And the last one we're going to talk about is really the Innovator and defining they have income, buffer, and barrier ETFs. This you have to do your research, guys. They are more of a structured outcome so you know exactly what you're getting. For example, when you look at the Innovator's defined income ETF, tries to offer income which it's generating, built-in risk control, meaning there is buffers and barrier levels that it won't go above or below, which helps really blunt the downside if the market turns. But of course, you are giving off and really losing some of those upside potentials because it is capped both ways. Now, you don't need to pick just one of these. You could dig deeper and look at how many there are. When you start looking at some of the NEO funds, when you start looking at some of the Yield Max funds, when you start looking at the Roundhill funds, there are a crazy amount of ETFs that are coming out in the marketplace. So, what exactly are some of the pros and cons to some of these? Passive income ETFs, extremely low fees, very broad market diversification in one single ETF, very transparent, very easy to track, and historically have great returns. When we start looking at the S&P 500 yielding about a 10.5% return, it is pretty incredible to see. Now, of course, the cons for these, no downside protection. If the market drops 30%, your S&P 500 fund is going to drop 30%. Now, of course, you can't actually beat the market because you're just tying the market or staying in pace with the market. And it also could mean, like we're seeing right now with the tech sector, it could be really overweight in some sectors, like the S&P 500 with where tech is. So when it comes to these active ETFs, the pros for these, availability and really adaptable to the changing markets because you have someone actually going in these ETFs and are changing. So you can have more of a defined outcome. You have the protection, you have income, you have those buffers, and hopefully, potentially, the big side of this is beating out the market itself. Now, of course, the cons with these are the drawbacks, higher fees, higher costs, and you're reliant on an actual manager which has skills. When we start looking at a 30 to 40 year time frame of the S&P 500, most managers cannot beat them. Now, of course, with this, it does come with a little less transparency, a little bit more complex when it comes to the strategies, and it could also limit where the growth potential you see in there. So what does the data say about this? In 2024, like we said, $31 billion of inflows. And of course, when we start looking at the outcome, ETFs are growing faster than anything. Asset manager have driven and really risen dramatically in the last year. Fixed income ETFs are the one that is really driving this. People want money and want money on a regular basis, almost replacing your paycheck. So which one of these are absolutely right for you? If you're long-term, honestly, go in there, buy the passive ETFs, buy the market itself. Honestly, the passive is always going to be the core when it comes to a strategy in investing. And when you start looking at the QQQ or the VOO, they have really have a big driven track record. Now, of course, if you need that downside protection, if you think there's going to be a big drawback, if you want that additional income, if you're comfortable with complexity, paying a little bit more to have these managed ETFs, it can be super useful to invest in these. And of course, when it comes to most investors, they might do a combination of both, where if you're holding, let's say 70% in the VOO, and then doing some satellite positions based on specific goals, such as income or those derivatives that we've been talking about. So here's the takeaway from the video, guys. If you're looking and really passive incomes are tried and true, when it comes to those ETFs, they low cost, very simple, great core when it comes to building, but active ETFs are evolving and really evolving super fast, offer a lot of tools like the protection, options, income. We have the factor rotation. The key is understanding the trade-off and making sure that you're not going to be the one holding the bag if you're losing money. So what do you think about it? What do you prefer? Are you going passive? Are you going active? Are you doing a blend of both? Let me know in the comments what you think of the strategy. And if this video was helpful, definitely hit that like button. Subscribe to the channel if you want more, and check out the next videos that are coming, and I'll catch you in the next one.